Hi everyone, it's now mid-November, which makes it a perfect time to talk about year-end tax strategies. And the first topic I'd like to touch upon is retirement plan contributions. My name is Jennifer Golstead Lee. I'm a cross-border tax and estate planning attorney. I help individuals and families with lives and assets spanning international borders. These are people in my community, and my living and working experience in different legal systems really brings me the ability of adding the real life perspective in every plan I create. And I love helping people navigate through the complex web of U.S. international tax. And I love seeing my community and the people in my community thrive. So the basic rule when it comes to year-end tax strategy for retirement contributions is to simply max out your 401k or IRA. As most of us know already, in the U.S., we have qualified retirement plans that are sponsored by employers like 401k, 403b, and TSP. And the employee contribution limit is up to $23,500 for 2025, and it's even more with catch-up contributions that are available for those who are age 50 or older. This money comes out of your paycheck before taxes, which means it's going to lower your taxable income. And of course, the earnings will grow tax-free until you take out after your retirement. But what if you live abroad? Now, for my international friends, listen up. This could be tricky. Number one caveat is not all foreign income is counted towards your U.S. IRA. For example, if you have SEP IRA and now all of your self-employment income that's going to be the basis of SEP IRA is happening in a foreign country, there will be an interaction between your income that's going to be the basis of IRA calculation and foreign earned income exclusion is going to affect your ability to make the contribution into your SEP IRA. So please double check on that calculation before you do that. And if you're working for an employer who's providing a foreign employer-sponsored retirement plan, you still might be able to contribute into your U.S.-based IRA. It's because foreign employer-sponsored retirement plan is not going to be considered a qualified retirement plan in the U.S. The second point I'd like to bring to the attention of global U.S. taxpayers is that you need to be careful before you start investing into foreign retirement fund accounts. It's because it may trigger a very complex reporting regime in the U.S., which is called PFIC, that stands for Passive Foreign Investment Company. This reporting is not basic. The IRS is estimating about 17 hours for record keeping only, 11 hours for learning, and 20 hours for the actual form preparation and filing. So please make sure before you jump into this kind of investment in a foreign country that your compliance is there and your accountant understands the complexity of these things. Now, the third thing I'd like to bring to your attention is treaty effect. So if there's an income tax treaty between the U.S. and your foreign tax home country, it could make it more complex as to how your retirement contributions or distributions are taxed. So if you're dual status resident, please make sure you understand treaty provisions as to your retirement contributions or distributions before you jump into the retirement plan in a foreign country. So maximizing retirement plan contributions is still a good idea in many cases for lowering your U.S. tax bill. But if you're an international taxpayer, don't guess. Get your cross-border tax advice because you need a plan that works on both sides of the border. Thank you for watching. Bye.